Hello, good morning everyone, and welcome to this online webinar session where we'll be discussing bonds, treasury bills, and mutual funds. My name is Dr. Aderemi Banjoko from NextGenFL. We're an organization trying to educate the youth about financial matters and trying to break down these financial terms and financial terminologies for everyone so that everyone can begin to understand them and apply them rightly. So without much further ado, we'll kick off and discuss to you what these bonds, treasury bills, mutual funds are all about, and what, most importantly, what do they mean, to make sure you all understand them. On your control panel, as you're listening in, you should see your control panel on your computer. So if you want to ask questions, you can there's a hand button on your control panel. So you can just click the hand button if you have a question. And also on the control panel on your computer and the software, there's a comment or question box. You can send questions or comments through that too. So if you have a question, just click the hand button on your control panel or send your questions or comments through the question box. But I'll take all the questions at the end of the session. So for those who just find out about NextGenFLX for the first time, like I said, NextGenFLX is set up to educate and mentor the youth on financial matters. You can go to our website for more details. That's our website there, www.nextgenflx. Obviously, NextGen stands for Next Generation, and FL for Financial Literacy. So you can just go to our website, NextGenFLX. We're also on social media, so you can go to our Facebook page. Again, all our social media handles are just NextGenFLX. We have lots of information and educational material on our Facebook page, so you do go to our Facebook page, like the Facebook page. You can interact with us via Facebook page and also via Twitter and Instagram and Snapchat. And like I said, all our social media handles are NextGenFLX. Also, the recording of this session will be posted onto the website. So if you view the blog at by tomorrow, it will be on the blog on the website. And also, if you go to the events and seminar section too, let me just click there. So if you go to the events and seminar sections too, the recording too will be just beneath this webinar event here. We'll post the recording beneath the event there, and also on the post and videos blog section of the website. So you can watch the videos there from tomorrow. Okay, so let's get back to the presentation and start talking about bonds, treasury bills, and mutual funds. So we start by asking ourselves, what's a bond, or what are bonds? So when you hear bonds, there's a word that's bandied around a lot. So what actually are bonds? What are they? So a bond basically is an IOU. That's basically what a bond is. So basically, you as the investor, you're loaning money to a government or a corporate body, and they pay you back with interest. So that's basically what a bond is. It's just an IOU issued by the government or a company, saying that they will loan money from you, the investor, and they will pay you back your money with interest. So that's the simple, basic definition of a bond. So basically, it's you saying you want to loan money to the Nigerian government, for example, or you want to loan money to Guarantee Trust Bank or Dangote Cement. So these companies or the government, when they're trying to raise money and raise capital and raise money, one of the ways they can do that is to come to people like yourself and ask you, can you loan me some money? And if you agree to loan them some money, they'll say, okay, if you loan us some money, we'll pay you back with interest. So that's what a bond is. So A bond is just that IOU agreement between you and the government or the company issuing the bond. So that's what a bond is. Now, the beauty about bonds is that they have a predictable stream of payment. So this interest the government or the company pays to you on how much you've loaned them, it's a fixed interest. So you know that they're going to be paying you this interest for the duration of the time you're loaning them the money. So you know you're going to get a predictable stream of income. So you know that at a certain time, the government or the company is going to be paying you interest on the money you've loaned them. And then obviously at the end of the loan term, they will pay you back the initial money you loaned them. So that's the beauty about bonds, is that they have a predictable stream of payment. And this payment, of course, is the interest on what you've loaned the government or the company. And at the end of the term of the loan, they then pay you back the initial money you loaned to them. So this is one of the big advantages of bonds, the predictable stream of interest or payments, and then they pay you back the capital or the initial loan you gave them. Now, this interest rates that the government or the company pays you, it can be fixed, which is the most common. So they can decide that if you loan them the money, they will agree on a certain interest rate they'll pay you, and they will pay you that fixed amount of money at a fixed time. So they pay you that interest at a fixed time. So usually it could be every 6 months. So every 6 months they pay you a certain amount of money. Or it could be floating. That means they can pay you at variable times. Or sometimes they will tell you they will lump all the interest together and pay you all the interest at the end of the term of the bond or the end of the term of the loan. So again, you can look at the bond as a loan. You loaning the company or the government money. So at the end of the loan or the bond, they can lump all the interest together and pay you at the end. But like I said earlier, the ones that is most commonly used is paid you at a fixed term of they pay you a fixed interest at a fixed time, maybe every 6 months, which is usually the case. They pay you the interest every 6 months. Now, this interest that they pay you is a percentage of the money you've invested or the money you loaned to them. So I just have an example here. So this is an example. So say, for example, the government or the company comes to you and they say to you, can you please loan me some money? And you say to the government, okay, I will loan you 10,000 naira or dollars or pounds or whatever. So let's just say 10,000 naira. So you say to the government, I'm going to loan you 10,000 naira. And the government will say, okay, well, thank you, I will pay you back 16% interest on the 10,000 naira you've loaned me. So that's the agreement. So the government has agreed to loan 10,000 naira from you or borrow 10,000 naira from you, and they'll pay you back with a 16% interest on the 10,000 naira you've loaned them. Now, 16% of 10,000 is 1,000 per year. So this interest, I must mention that that's very important. This interest they're paying you is per year. So it's a 16% interest per year. So it's a 16% interest on what you've loaned them per year. So 16% of 10,000 is 1,600 naira per year. So that's what they've agreed, that they'll be paying you 16% of the 10,000 a year, and that 16% of 10,000 is 1,600 naira per year. And like I said, this can be paid twice a year, which is commonly the case. So if they're paying it twice a year, they'll just split the 1,600 into two, and they'll pay you twice a year. So that means they'll pay you 800 naira every 6 months. So that's a way to look at the interest. So when you're loaning the government money or you're loaning a company money, you want to find out what interest are they going to pay you on the loan you're giving them. And this is how you can easily work out how much you'll be getting on the amount you've loaned to them. So again, 16% on 10,000 is 1,600 a year, and they can pay you this twice a year, so they break it down into 800 every 6 months. And that's what you'll be getting every 6 months till the money you've loaned them or the term of that loan expires. And the beauty about this is that this interest can be compounded. And I think in the coming weeks we'll discuss compound interest in more detail, but this interest can be compounded. So this makes bonds a very good investment for everyone. So it's very good for everyone to look at buying bonds because of this fixed interest you can get. It's predictable, it's safe, so it's a very good investment for everyone. Now, like we said earlier, this loan has a term, so you can, when you're loaning the money to the government or loaning money to a company, you have to know how long are you going to loan them the money for. So are you going to loan them the money for 1 year, 2 years, 3 years, 5 years, 10 years? So how long would that loan be for? And once you've decided you're loaning them the money for 3 years, for example, then they'll be paying you that interest for 3 years. If you're loaning them the money for 5 years, they will just keep paying the interest to you for 5 years. And at the end of 5 years, they'll give you your initial loan sum back. So you want, and this was called maturity of the bonds. So the term you loan them the money for is what's called the maturity. So if you loan them the money for 1 year, it means that bond has a maturity of 1 year. If you loan them the money for 3 years, it means that loan has a maturity of 3 years. If you loan them the money for 5 years, it means that bond has a maturity of 5 years. So that's another important thing to remember regarding the maturity of bonds. So the maturity is the specific future date when the investor's principal will be repaid, and this can range from 1 day to 30 years. So there are very different ranges for durations of bonds. So the categories of maturities for bonds are, for example, you can have what we call short-term bonds, whereby the term of the loan is from anything from 1 to 5 years. So anything from 1 to 5 years is called a short-term bond. Intermediate bonds is anything from 5 to 15 years. And long-term bonds is anything from 12 years and above. So that's what you call long-term bonds. So like I said, I will take all the questions at the end. So if you do have a question, like I say, you can click the hand button on your control panel or send your questions or comments through the question box. I can see a hand up, but you can leave your hand up. And like I said, I'll take all the questions at the end. So following the bonds, we'll discuss Treasury bills, or they're commonly called T-bills. So T-bills just stand for Treasury bills. So what are Treasury bills? They are more or less similar to bonds in terms of it's a loan to the government. But Treasury bills are specifically to the government. Whereas with the bonds, it's you loaning a government or a company money. But most of the time with Treasury bills, it's mainly the government you're loaning money. Now, this Treasury bill is a short-term debt that's issued by the government through the central bank to provide short-term funding for the government. So it's the government looking for money to pay salaries, to pay for the running of services of the government. So that's how they sometimes raise money, is by issuing these Treasury bills and asking people to loan them money for short term. Again, that's another difference between bonds and Treasury bills. As we've said just earlier, bonds can be anything from 1 day to 30 years. So the duration of bonds can last for 30 years. Whereas with Treasury bills or T-bills, the duration is very short in terms of the term of the loan. So by their nature, they tend to be very easy to buy and sell because of the short duration they have. So that's why the liquidity just means you being easy to buy and sell things in the market. So that's what you call liquid. So if something is liquid, It means you can easily buy and sell that product or that instrument. And treasury bills, they are very liquid and they're very easy to buy. And again, they are backed by the guarantee of the government. So like I said, they're short term, so they're usually issued and they usually last for anything between 91 days or 182 days and a maximum of 364 days. So you can see they're short term as opposed to the bonds that can last for up to 30 years. So that's the major difference between treasury bills and bonds. So number one, bonds can be issued by governments and companies. So you can loan, so when you're talking about bonds, you can loan money to the government or you can loan money to a company. So you can do that with bonds. But with treasury bills, it's mainly you loaning money to a government. The other difference between bonds and treasury bills is that bonds can last for a very long time. So you can loan the government or a company money for 5, 10, 15, 30 years. But with the treasury bills, the loans are short term. So you can only loan the government money for about 91 days or 182 days or 364 days. And the third and major difference between bonds and treasury bills is the interest you get in them. So with treasury bills, you buy them at a discounted price. So which means that the price that you buy a treasury bill is less than the face value. So basically what that means is that, say for instance, a treasury bill is going for 1,000 naira. They might sell it to you at a 10% discount. So instead of you buying it at 1,000 naira, you buy it at 900 naira. So you can see you already made 10% profit because the face value is 1,000 naira, but they've sold it to you at 900 naira, 10% less. So that's again how treasury bills work. You get the interest upfront. So and that upfront interest can be reinvested to earn compound returns. So that extra 10 naira that you have with you, you can then reinvest it in another instrument. So that's the beauty about treasury bills. You get your interest upfront and it's risk-free because again it's backed by the government. So that's another good thing to know about treasury bills. Now these are the current interest rates you get on bonds and treasury bills. In the US, if you buy a US government bond, you can get an annual interest rate of 2.55%, which is quite low. So for the US, you can get 2.55%. In the UK, if you buy the UK government bond, you get 1.29%. In Japan, if you buy the Japan or Japanese government bond, you get an interest rate of 0.09%. In Germany, 0.54%. And then in Nigeria, the bonds you buy can range from 12.09% to 17.5%. So these are the current bond and treasury bill rates in different countries, depending on where you are. And maybe in Nigeria, that's Nigeria 12.09% to 7.5%. Okay. So the final topic we'll be discussing today is mutual funds. And the reason why I added mutual funds to this presentation is that as you'll see shortly, when you want to start buying bonds and treasury bills, especially if you don't have a lot of money to invest, you can buy them via a mutual fund. So what is a mutual fund? Basically, a mutual fund is just, investors. So you can see in this diagram here, this group of people here. So these are the investors like you. So like you all on the call today, that's all of you here with your money. So you all pool your money together and invest it in a fund house. So these are just different investors bringing all their monies together. So different investors like all of you on the call. You all bring your monies together and it's put in the fund house. And then the fund manager helps you invest that money in the financial markets. So they can buy stocks and shares for you. They can buy bonds, treasury bills. So they do all that money for you, that work for you. And of course, they have a better clout because of the massive amount of money they've gotten from various investors. They can get better deals and do better investments for you individually that can do on your own. So they do that. They invest all the money. They generate a lot of returns for you, and all this money and the returns they get is passed back to you who've invested in a mutual fund. So that's basically what a mutual fund is. So it's just a pool of investors pulling their money together into a fund house. The professional fund manager then takes all that money and invests it in the financial markets, and they generate good returns, and these returns are passed back to the investors like you who invested in the mutual fund. Now, the other beauty about the mutual fund is that they can vary. So the fund manager can decide what assets he's going to invest in. So there are different types of mutual funds. You can have some mutual funds that invest in the real estate market. You can have some mutual funds that invest in the stock market. You can have some mutual funds that invest in bonds and treasury bills like we've just been talking about. You can have mutual funds that invest in commodities. You can have mutual funds that invest in different countries. And then you can have mutual funds that just do a mixed bag of everything. So, there are different types of mutual funds. So if you're going to invest in a mutual fund, you need to know what that mutual fund is investing in. Now, the one I will talk about today, which is relevant for us today, is the money market mutual fund. Because the money market mutual fund is a mutual fund that invests in what we've just been talking about. It invests in the bonds and treasury bill market. So that's what this money market, that's why it's called the money market. The money market means, bonds and treasury bills and, commercial paper. But let's just say, in essence, bonds and treasury bills constitute what we call the money market. So when you hear the money market, it's really relating to bonds and treasury bills that we've just talked about. And so if you have a money market mutual fund, it means that that mutual fund is investing in treasury bills and bonds. So obviously, if you want to invest in a money market mutual fund, you need to make sure it's registered with the Securities Exchange Commission. So it's a regulated fund. And like I say, it's a pool that is diverse into investments in the money markets and short-term debt securities, which is the treasury bills. And they try and give you a high return on a daily basis. And again, the beauty about this mutual funds is that they compound your interest. Now, the minimum duration of the fund is 90 days, and the interest earned is every 90 days. So this can be reinvested, and your interest can be compounded. Or if you want to have the interest paid out to you when it comes due, you can also do that. But if you really want to have full benefit from the mutual fund, you want to reinvest the interest so it can be compounded and you get more for your money. Now, the current average annual return on this money market mutual funds is about 17%. So you can see that's not a bad annual return for your money. So if you want to start investing now, a money market mutual fund is a good one to start with because it's safe, it's backed by the government, it has very low risk, and you can get an annual return of about 17% compounded over time, which will make you a lot of money. So that's basically it about mutual funds. So here's just a short quiz, just for fun. So again, like I always use in the talks I give, the quiz questions is, what did you learn from today? And again, what do you plan to do from today? There are no prizes, just for fun. So just, what did you learn from today? Short thing, and what do you plan to do from today? And then you can just send your answers in text or video format via our social media at NextGenFLX using the hashtag NextGenFLX and the hashtag quiz. So I'll just quickly repeat, and then we're going to take questions. And I'll answer all your questions, as many questions as you want. So yeah, number one, remember, what did you learn from today? That's the first question. Number 2, what do you plan to do from today? And like I say, send your answers in text or video format via social media at NextGenFLX using the hashtag NextGenFLX and the hashtag quiz, so that we know that you're responding to this quiz. So and obviously you can share that with your friends and colleagues, and let's just have some fun with that. So spread the word, hashtag NextGenFLX, and join us on social media. And don't forget our website. You can go to the website nextgenflx.com, and if you want to send us an email, you can email us at info@nextgenflx.com, and those are our social media handles: Facebook, Instagram, Snapchat, Twitter, YouTube. All our handles are NextGenFLX. And like I said, from tomorrow, the recording of this session, although I will send you all out a link, but if you don't get the link, well, you should all get the link. I will email it to you later on today, but the recording will be on the website from later on today, the recording of this session. So if you go to the events and seminars section of the website, you will see the recording there, or you can also go to the post and blogs, post and video section, and you will see the recording on the website. Okay, so any questions? Let's see. So like I say, if you have any questions, just click the hand button on your control panel or send your questions and comments through the question box. So I'll take all your questions one at a time. It says, please can the whole lesson be sent to my mail? Yes, so like I said, all of you who've attended this webinar session, I'll send you a link for the recording. But like I say, it's going to be posted on the website, but I'll send you the link to this exact page on the website for you can watch the video as often as you want to. Let's see, it's another question here. I'll just unmute you, and